Next panelists up here on stage. Let's welcome Mr. Sanjay Purao, Executive Director, Securities and Exchange Board of India, Mr. Avishkar Naik, Senior Vice President, National Stock Exchange of India, Mr. Prashant Vagal, Chief Operating Officer, National Securities Depository, and Mr. Rajesh Saraf, Chief Data and Operations Officer, CDSL. A warm welcome to all of you. We request your presence on stage. And audience members, kindly settle down quickly, please. We're about to begin the next session. Okay. Okay. We also have Mr. Vishal Gupta, the Deputy CTO, NSDL, joining us amongst the panelists. A warm welcome to each one of you. And may I request Mr. Sanjay to take forward the proceedings. Thank you.
Thank you so much. Thanks for the gracious invitation. And thanks to the organizers as well. Well, it's a very privileged opportunity to be addressing all of you here. And we have a very interesting session, a lot of interesting panelists as well. So this is how we are going to have videos and discussions on how technology has enabled few very important reforms in our securities markets. Many of these are not directly visible to the end users, but trust me, they go a long way in making life simpler for the industry at large. So without any further ado, I would start the discussions. Maybe my colleague from CDSL would have a brief interaction with you on the topic and the videos which we have to play. Because while we believe a picture is worth 1,000 words, an audio video is worth even much more. So that will set the stage for how we go about interacting in this forum today. Thank you, sir.
Good morning. Thank you, Sanjay sir. In terms of the investor enablement and client asset protection, the first theme that we would like to present here today is margin pledge repledge. I will just give a brief introduction about this framework that has been introduced under the regulatory guidance. In terms of the margin pledge, as we all would be aware, it's an integral part of the margin trading framework or mechanism within the Indian markets, where any client who wishes to trade in the stock markets wants to utilize the collateral, securities in the demat account as a collateral, needs to actually get into margin pledge mechanism. So herein the client actually pledges the securities from his demat account in favor of a designated trading member or a clearing member, who then provides him requisite exposures for him to trade in the market. Before the margin pledge system came into picture, clients used to actually transfer the securities from his account to the trading member, clearing member account, which basically amounted to a client title transfer of the securities. So it was actually a physical transfer going from one account to the another, and therefore it was full of inherent risk in the system. There was a risk of misappropriation, there was a risk of misuse of the securities by the trading clearing member, wherein he could actually utilize those securities for the pay-in obligations or settlement obligations of the other client or for himself as well. Plus, there was also limited transparency in terms of where your securities are once they're actually moved from your account to the broker account in terms of the usage, how and where they're being used. And on this background, the stock exchanges, clearing corporations, depositories, and the market participants as well came together and under SEBI's guidance basically devised a framework called margin pledge repledge framework, which basically was aimed to achieve following objectives. One is to mitigate the risk of misappropriation of misuse of client securities by the market intermediaries, to provide transparency to the market, as well as to enhance investor protection. So how does this entire framework works? Basically under this system, securities are pledged. If you are wanting to use these securities in your demat account as a collateral for trading, they have to be pledged only in the form of the margin pledge. That's the first diktat. Second is, in terms of the securities which are there in the demat account, these securities so pledged are in the favor of broker, but they continue to remain in the individual client account. So that's the advantage of the entire margin pledge repledge framework, that you don't have to do a title transfer into the other account. They continue to remain in your account. Therefore, you continue to enjoy the benefits on that particular securities going forward, as and when the margin pledge is going on in parallel. So you continue to receive, let's say, corporate benefits, you continue to have voting rights, and things like that. Plus, a facility of repledge is also provided, wherein these securities can be repledged by the trading member further to the clearing member, and clearing member can further repledge that to the clearing corporation, as the case may be. And his entire journey, again, the securities continue to remain in the demat account of the client itself. Only the pledge is forwarded from TM to CM, CM to clearing corporation. So throughout this process, again, there's a complete visibility for the client available in terms of where his securities are and how they are being utilized. Plus, all this mechanism is conducted through the established channels, which is set up by the MIIs, which are the trusted institutions in the market. And there are various added controls which are provided by the MIIs in terms of ensuring a complete safety and convenience to the users as well as to the intermediaries. So, for example, when the margin pledge request is set up by the client on the trading member portal, what happens is typically that member actually forwards that to the depository, because the pledge has to take place in the depository system. So at that point of time, it's a B2B transaction coming from a trading member to the depository, but the depository ensures that the client is made aware of it. So depository will send a confirmation to the client, to the end client in that respect, on the mobile number and the email which is registered with the depository of that particular client. And only after getting the OTP confirmation and a 2FA authentication, then the transaction will proceed through. So that's kind of a B2B transaction setup in the system, but requiring a B2C authentication from the client. So that's the kind of control which the depositories have put in to ensure there's a complete safety available for this mechanism. In terms of further changes in the margin pledge system, there are various changes which are taking place as the framework has evolved over a period of time. But to summarize the whole thing, as I said earlier, it basically ensures that the client asset protection is available. It also mitigates the risk of fraud and misappropriation in the system. It promotes transparency, convenience, and safety in the Indian markets. So with this introduction, let's look at the video, which actually gives more information about this framework.
The client asset protection objective of the regulator is a cornerstone of its regulatory framework for ensuring transparency, security, and trust in the Indian securities market. Initiatives like the margin pledge system are designed to safeguard investors' assets, mitigate risks of misuse, fraud, and operational inefficiencies associated with intermediaries such as brokers and clearing members. Before the introduction of the margin pledge system, investors had to transfer their securities to the broker's account as collateral to avail margin funding. For this, many investors gave brokers a power of attorney, authorizing them to transfer securities directly from the investor's demat account to the broker's account. This system had significant flaws that exposed investors to risks. Risk of misuse and fraud, as brokers had complete control over the securities. Lack of transparency, as investors lost visibility and control over how and where the securities were being used. Challenges in retrieving securities once the margin requirement was fulfilled, or trading ceased due to operational errors or broker default. The system lacked robust checks and balances to ensure securities were used solely for the stated purpose, increasing systemic risks in the market. The margin pledge system eliminated all these risks by ensuring that securities remained in the investor's demat account even while pledge and repledge was made safe and convenient, blocking unfettered access to client securities, reducing the risk of misuse or defaults impacting investors. Here is how the margin pledge system works. The investor selects the securities they wish to pledge and initiates a pledge request through the broker's platform. The broker sends the pledge request to the depository. The investor receives a link from the depository to confirm the pledge. This involves entering their PAN number and generating an OTP. The investor receives an OTP on their registered mobile number and email. They enter this OTP to confirm the pledge. Once confirmed, the depository marks the securities as pledged in the investor's demat account. The broker can now use these securities as collateral to provide margin. The margin pledge system also makes it easier for brokers to further repledge the securities to clearing corporations for their own margin obligations. It facilitates repledging in a controlled and transparent manner, ensuring the securities ownership remains with the investor throughout the process. The margin pledge system also allows securities to be easily unpledged once investor repays the margin or no longer needs to pledge the securities through an unpledged request initiated by the investor. Margin pledge system for enhanced investor safety and increased trust in the capital markets.
Thank you. The next theme that I would like to present is called System-Driven Disclosure for Trading Window Closure Framework. This is an automated framework for freezing This is an automated framework for freezing the transactions of the certain individuals during the trading window closure period. So it's a RegTech initiative in the Indian markets to facilitate regulatory compliance in terms of the insider trading regulations. And as you would be aware, the insider trading regulations is a critical compliance requirement for ensuring transparency and investor protection of the markets. It is basically designed to prohibit specified individuals of the listed company who have access to unpublished price-sensitive information, which we normally say as UPSI, from using such UPSI for their own benefit or for their personal gains while trading in the company's securities. So these individuals under the PIT are called as designated persons, the DPs, and they are identified by the company themselves, typically by the compliance officer. And these designated persons could include employees, board of directors, promoters, etc., who are having access to UPSI. So that's the first concept about designated persons, then UPSI. And the third concept is basically, as per the regulations, these designated persons should not trade in the securities of the company when the trading window is closed or during the trading window closure period. So that trading window closure period is again defined by the company, which is typically for the quarterly financial results announcement during that time. So it is, from the end of the quarter till 48 hours from the declaration of the earnings. That's how typically the trading window closure is defined. Process before the automated framework of trading window closure came into picture was actually completely manual, wherein each and every company and company compliance officer was actually monitoring these transactions of their designated persons in a completely manual mode. And there were company-specific practices which were followed. It was a post-facto system, and therefore it was prone to a lot of errors and delays and, of course, non-compliances. And therefore, to rationalize all this, stock exchanges and depositories came together under the guidance of SEBI to formulate a system at a centralized level, and a systemic solution was developed to build a preventive check to restrict this trading by the designated persons during the trading window closure period. And this is an automated mechanism which is provided by the designated depositories. So both the depositories provide this solution to the listed companies, wherein these companies can update or provide the PANs of these designated persons to the depository. PAN, as we all know, is a unique identifier. And they also define the trading window closure period with the depository system and also activate the same. Based on these details, what depository system does is basically it provides an automated mechanism to ensure that the freezes are applied in these accounts, basically for all these PANs. So depository system basically looks at, for a corresponding PAN, what are the various demat accounts which are held in its system, and for all such demat accounts, the freeze is applied. It also includes the single holder as well as joint holder accounts. The freeze is applied for a particular trading window closure period, that is from start date to a particular end date. The freeze is applied only for the transactions in that particular company. So for example, if you are having, considered as a designated person for XYZ company, but you are having holdings in the other securities also, the freeze will be applied only for ISIN XYZ and not for the others. So that is another flexibility that is available in the depository system. Also, the freeze is automatically lifted when the trading window closure period is over. Now, typically the companies can approach any depository to provide this, a list of designated persons, which they think is a preferred depository. But in order to facilitate the market-wide compliance, both the depositories as well as stock exchanges have come together, wherein depositories are sharing this information with each other and also with the stock exchanges, so that they can also correspondingly take the similar action at their end in terms of freezing these accounts. So the framework has been in place for some time, and it has evolved over a period of time. Initially, it had a basically glide path was provided to all the companies to adopt to this framework. Initially, it started with top 50 companies, then next 1,000, then further next 1,000, and it has been now made available to all the listed companies in the country, which is more than 5,500 companies in the country. So based on the market adoption, various new enhancements also are being brought in. So recently, such new enhancement which has been brought in is in July 2025, wherein along with the designated persons, the immediate relatives of these designated persons also have been brought in under this framework. So the companies are required to give the details of immediate relatives of such designated persons, which are again captured in the depository system, and similar phases are applied. So overall, if you look at it, it's a very unique implementation in the Indian markets. To the best of our knowledge, we do not have any such parallel in any other world market compared to what we have out here in terms of automated freeze being applied. It's system-driven, it's automated, therefore it is proactive in nature, and therefore far more robust and structured. And of course, as per for the market adoption, a glide path also has been provided by SEBI for implementation of it. And more importantly, it is enabled by the first-line regulators, which is the exchanges and depositories, as opposed to it being applied individually by various companies. Therefore, it strengthens market transparency, empowers market, and of course, strengthens the investor protection cause. With this, let us look at the video on trading window closure, system-driven disclosure.
Trading window closure, or TWC, is a critical compliance requirement under SEBI's prohibition of insider trading regulations. Earlier, companies relied on a manual process. Compliance officers had to manually update lists, send emails, and monitor trades during trading window closure periods. This was slow, error-prone process and often led to delays, inaccuracies, and regulatory risks of non-compliance. Now under SEBI's guidance, stock exchanges and depositories have introduced an automated framework. Companies simply upload the PAN details of designated persons and their immediate relatives and set up freezing period in the system. The system automatically freezes the PAN ISIN combination during the closure period, while SMS and email alerts are sent instantly. This automated system eliminates manual errors, ensures accurate and timely compliance, and reduces the burden on companies. By restricting trading by designated persons and their immediate relatives, the new mechanism acts as a preventive check instead of post-facto monitoring, strengthening transparency and investor confidence. The automated trading window closure system, simplifying compliance, enhancing transparency, and empowering markets.
Thank you.
Is this better? Yeah, okay. Fine. So we saw some very good presentations here. A lot of hard work and I think effort has gone into ensuring that we achieve our end objective of client asset protection, because this Repledge was had a lot of issues over the last couple of decades in our capital markets. Because client securities, whenever they used to be given as collateral to the broker, we used to receive a lot of complaints on unauthorized use of collateral, maybe improper uses. So a lot of our complaints emanated from this particular issue. And we are glad that we could take this forward and have a pioneering role to play in this pledge and repledge, which I think is unprecedented. We don't see that happening anywhere else in the world. So it has worked very well, and I'm sure we'll come towards the, at the end, we'll see what are the benefits and what is the way forward in making this, using this to make our markets even much more safer. And the second discussion which we had was on the trading window closure. That was more towards increasing the enforcement which we have in our capital markets, especially with respect to insider trading. We wanted to ensure that we have a system-based approach rather than a manual approach which was prone to errors. It gave rise to inadvertent non-compliances, eating up a lot of regulatory resources, as well as wasting the time of the market in ensuring that there is compliance. So it's good to see that CDSL has ventured and along with other MIIs has given a tech-based solution to our markets. The next session which we have is by Mr. Avishkar Naik. It is on something which we are very proud of. It's ASBA. It's how we democratize access to our markets and how we ensure that the funds are available quickly to the companies, as well as make sure that funds are available back to the investors to invest in additional securities. So, Avishkar, here to you.
Good morning. It's a pleasure to be part of this GFF 2025. Indian capital market has witnessed remarkable transformation in various areas. Majorly, if you look at it, it is on the number of registered investors coming into the market, the number of products being launched, and the number of issuers approaching the market. To give some stats, last year on the IPO front, we were the top market globally. We raised around $19.9 billion. And this year also the pipeline is stronger. On the investors front also, so for the first 10 million investors to come to the market, we required around 14 to 15 years. Whereas the last 10 million investors have joined us in a period of only 6 or 7 months. That's the pace at which we are growing. What SEBI, exchanges and depositories and other entities are trying to do is create an ecosystem so there is a seamless listing, continuous flow of information to the market, and at the same time the rights of investors are getting protected. So when we talk about it, we as MII, we have a regulatory mandate, but we are linked to other MIIs also, and basis that cooperation which we do, we come out with different innovations and products. So one of that major product was ASBA. ASBA, or application supported by blocked amount, changed the way in which we invest in our markets. So what typically used to happen is previously you had to transfer the money from one account to another even before the transaction has taken place. Whereas once ASBA got implemented, now the funds remain in your account. You continue to get the benefit of the interest on that amount, and it gets transferred only once the transaction is completed, and that too for the specified amount for which the transaction has taken place. So what it has tried to do is reduce the administrative part in a significant way for both for the investors and the issuers. From a risk perspective also, it has tried to avoid commingling or custody related risk. Then complementing ASBA, UPI was introduced, which enabled T+3 listing. So earlier in India, there was we traditionally used to take around 6 days after the issued close to get a security listed. So with the implementation of T+3, what has happened is we are able to get the security listed within 3 days. From an investor's perspective, that uncertainty period has got reduced. And from an issuer's perspective, it is advantageous as he has access to the funds on a faster basis. So to conclude, as India's capital market keeps on evolving, there will be new products and innovations which are in pipeline and which will keep on coming up, which will ultimately aim to look at how we efficiently and effectively manage the markets. So we have a short AV which will cover and capture what all changes and what all steps we took to implement this innovations. Thanks.
Fundraising through IPO has been streamlined to list the securities within T+3 from issue close day. ASBA, application supported by blocked amount. Alongside ASBA, UPI payment mechanism was introduced to ensure instant, secure and transparent transactions, allowing retail individual investors to apply for public issues through intermediaries like syndicate members, registered stockbrokers, registrars and transfer agents, and depository participants. Here's how the bidding through UPI works. Investor submits bid details and UPI ID, which is uploaded on the stock exchange platform. The exchange verifies the investor details with the depository. The stock exchange shares the details with the bank. The bank initiates mandate request for investor confirmations. The bank blocks the amount and shares the information with exchange. Stock exchange shares the information with registrar and transfer agents RTA for reconciliation and for basis of allotment. Qualified institutional buyer QIB and non-institutional investor NII apply through direct bank ASBA, and non-institutional investor NII apply through syndicate ASBA, alongside multiple other benefits like enhanced efficiency, minimized manual intervention, reduced waiting time from closure to issue, enables faster listing and trading of shares. Issuers gain quicker access to raised fund. Investors avail early liquidity. These digital and technology-forward reforms in IPO issue, allocation, and listing have significantly improved speed and efficiency of the processes, benefiting the financial market in general and investors and issuers in particular.
Yeah, thanks.
Thanks so much, Avishkar. It's a very insightful presentation. I think we can all see the benefits which it has brought to our capital markets over the last decade. So far we have seen client asset protection in the secondary market to the pledge repledge. How do we ensure continuous compliance through the trading window, automation process? And now we saw how technology works in our primary markets for equity. We have something similar for the debt markets, which NSDL will now lead us through. I request Mr. Vishal Gupta to take us forward.
Thank you. Good morning, all. So when you have two challenges to tackle, the first challenge being how do I bring more discipline and more transparency to the market, as well as the fact as to how do I protect the end investors, assets actually, right, their investments. And the second challenge being to solve this problem using an emerging technology like the distributed ledger technology, right? So these two were actually at the onset, these two were the challenges that we had in hand actually. And when you have a hammer in hand, not everything is a nail, right? So what it basically means is that yes, we had a technology called distributed ledger technology based on the blockchain, which kind of, the whole idea was that how do you maintain a decentralized store of information, right? But is it applicable to the kind of use case that we are talking about? So the first and the foremost piece which we had to address was, while SEBI was pivotal in terms of identifying this particular use case because of the kind of frauds that were prevalent in the market, the first challenge for us was to actually understand whether this is the right technology. So even before now, I delve into the fact that this particular authoritative data store, which was built out there on the distributed ledger technology, why did we at all start with this whole journey? So when you look at the corporate bond issuance market, specifically the debentures, so here what was happening was any such issuance has to be backed by assets, right? And when you talk at assets, right, the way these assets actually get codified, there has to be a unique way to identify each asset. And if you do not uniquely identify the way each asset is, each asset occurrence is out there, basically what it means is that the same asset can be recorded multiple times and can be used for multiple issuances. What it basically means is that when you have a default, you cannot rely on that particular asset which has been used multiple times for multiple issuances. So this is the first problem statement out there in the market. Second problem statement out there in the market was if you have an asset, every asset has a certain value, which basically is considered as an asset cover. And this asset cover is the kind of lien which actually provides the coverage to any issuance. So if you do not monitor this asset cover that this particular asset is going to be used for, and you end up using the same asset, so even if your asset is uniquely identified, but you do not monitor the way this asset is now linked to one or multiple issuances, what might happen is that this particular asset cover or the asset value is being used for multiple issuances, wherein you are actually breaching the asset cover, which typically this asset can vouch for. The third point being that when the health of the asset deteriorates, right? Basically what it means is if you do not take a view of a real time or at least on a regular basis, if you do not monitor the health of the asset, at one point in time, the asset which is backing the particular issuance, that issuance will actually not be a valid one, right? Because you, in case of any default taking place, you cannot rely on that asset. So which basically means that you need to have a process by which the health of the asset is getting monitored on a regular basis, right? And the fourth problem was that each and every issuance is actually associated with a number of financial and non-financial covenants, right? Financial and non-financial covenants, these essentially are checks which ensure that the assets which are backing these issuance, those are all secure actually, right? So if you do not monitor them on a regular basis, this can lead to breach of these covenants. And if these breaches are not monitored, identified and monitored on a regular basis, this can again lead to issues. So when you look at this 4 set of problems, and when you look at the kind of players which are out there in the market, you have close to 6,000 plus issuers out there in the market. You have only 12 to 15 debenture trustees who are actually monitoring their trust deeds, which are backing these issuances. You have the credit rating agencies which are actually doing the credit rating of these various issuances. Then you are having the valuation agencies which are actually valuing these assets, right? You have the stock exchanges which are part of that entire listing process, wherein until and unless the due diligence certificate which talks about the health of the asset, which talks about the ownership of the asset, which talks about whether there are any existing lien, that is the charges as we call it on the asset, unless that gets vetted out, the due diligence certificate for the issuance does not get generated. Post that, any such recording of charges need to take place, which typically today takes place in the ROC and the SARSAI, right, which was a manual process. Now, unless that takes place, the listing certificate will not be generated, and any of these listed debenture does not go out there on the market. So you are looking at a big number of stakeholders out there in the market and a very complex process which exists today. So how do you tackle it? The main problem here was trust, right? And if you do not address the trust which is out there, you cannot address this. So this is where NSDL came up with the entire process, wherein right from the asset recording to mapping of the assets to the issuances, subsequently validation of the due diligence certificates, generation of the listing certificates, and subsequent to the listing, the payments which get recorded, which is also an equally important point, because the cash flows which take place as a result of these issuances, eventually these cash flows are going out to the end investor. So if there are any defaults, right, those also need to get identified and addressed in a timely basis. So the entire covenant monitoring life cycle, right from the issuance of the debenture till the closure, is right now being monitored on the platform. And if you talk about, there are more than 600 plus issuers who are right now operating on the platform, with close to more than 11,000 assets right now there on the platform. And around 7,000 plus issuances now take place completely through this process, wherein the listing certificates have been generated as part of the process. So when you talk about this, such a cumbersome process, right? When we started looking at the DLT technology, there were a couple of challenges for us, because first things first, we had to prove that DLT is the right technology, right? The moment you all talk about DLT, you think about a distributed ledger, wherein you have, nodes which are being anchored by each and every player out there. But when you look at a market size, wherein you have 6,000 plus issuers, it does not mean that we are talking about creating 6,000 nodes. And market was also not ready to go for that kind of investment. So that's where the initial model which we came up with has essentially 4 nodes. The first node is a super user node, which is specifically for the issuers, right? All the issuers right now access the DLT platform through this node. Sure. So the whole idea here was that to ensure that the market is able to adopt this particular platform, we initially had an approach wherein we have super user nodes for the issuers, debentures, the debenture trustees, and the and SEBI for reporting purpose. And going forward in future, we'll be having 2 more nodes specifically for the credit rating agencies and the investors for them to get insights. So you can take a look at the video and post that if you have any questions specifically on how we went about the journey, I'll be happy to address.
Indian depositories have developed a state-of-the-art security and covenant monitoring platform for corporate bonds. Built on distributed ledger technology, DLT or blockchain, it's the first implementation of its kind in India and globally. With a private blockchain, critical bond data, including asset details, is securely shared and validated in real time, building trust for a future-proof market infrastructure. Historically, tracking bond security and covenants was tedious, lacking transparency, open to manipulation, and hard to enforce. This created a need for a unified, transparent system to protect investors. Recognizing this, SEBI mandated a solution. As a result, depositories launched this groundbreaking security and covenant monitoring platform. The platform tracks assets securing bonds and ensures issuers adhere to all their financial and non-financial covenants, along with timely payments of interest and redemption. On this platform, security creation is a 4-step process where information is recorded by issuer and verified by the debenture trustee. Step 1. Recording of assets. Issuer uploads details of assets as security. Step 2. Due diligence. Trustee verifies asset details, valuation, ownership, and existing encumbrances. Step 3. Charge creation. Issuer uploads charge documents, which will be verified by trustee. Step 4. Recording of charge. Issuer records charges filed with ROC, SARSAI, and NESL. Recording and verification. At the time of bond issuance, issuer records all covenants, credit rating, and payment schedule of interest and redemption payments, which is verified by the debenture trustee. Periodical monitoring. As part of the monitoring process, issuer submits updates on asset quality, covenant compliance, interest, and redemption payment, which is verified by trustee. Any rating changes are verified by the credit rating agency. This platform is based on a service provider model where depositories operate a central node and multi-tenant node for issuers, debenture trustees, and credit rating agencies, CRAs. The key features of this platform are authoritative data store, a single tamper-proof record of assets, covenants, and cash flows, an incorruptible digital vault, automated alerts, real-time notifications to all parties keep compliance on track, immutable audit trail. Every transaction is cryptographically secured with timestamps, creating a verifiable record. The impact has been phenomenal. In the listed bond markets in India, the platform is widely adopted, with all the issuers, trustees, and credit rating agencies already onboarded. Security and covenant monitoring platform is more than just a technological innovation. It's a foundation for a more secure and transparent Indian corporate bond market. By strengthening investor protection and improving market discipline, it's not just growing the market, it's building trust.
Thanks so much. I think that was a very enlightening presentation which we had. I think we are running short of time, but I think we have time just for a couple of questions from these important systems which our MIs have developed. Avishkar, I'll start with you. What are the basic advantages you see when we have systemized or automated many of the processes relating to issuance of equity securities?
So I will just give a separate take because we have covered in our sessions all the technical part and all that. Typically nowadays we speak about work-life balance and all. I will give you a live example. Typically around say 4 or 5 years prior, if there was a basis, in the sense once an IPO closed and the basis used to take place, that basis used to take place typically at 3 a.m., 4 a.m. and all that way. So what all this process developments or improvements over the period has done is, we have been able to complete all our processes within timelines and whatever big that IPO may be. So some few months back, we had one particular IPO where we got some 9 million bids. And that too, we were in that situation also, we were able to complete it within T+3 along with other IPOs on running in parallel. So this all changes have actually enabled us to take it from different angles.
Mr. Saraf, with respect to this margin pledge, repledge, what is the benefit which you would, one benefit which you would say the client or the end investor can envisage actually?
So the most important benefit here is the client asset protection. The securities do not leave the client account at all while the margin pledges are happening, and he continues to get the exposure in the market as per his requirements, but the securities do not move out of his account. So it actually mitigates the risk of misappropriation, misuse, and provides him the complete transparency with respect to what is happening to his securities in terms of the pledge mechanism. And at the same time, he continues to receive all the corporate benefits in those securities without losing any such entitlements.
Okay. And how is that advantage over the power of attorney mechanism which was prevalent?
So power of attorney earlier was being given by the clients only to the brokers, but they were found to be, in certain cases, not getting used in a proper manner by the brokers. which were leading to a lot of gray issues and issues with regard to Peter Paul kind of problems, that Peter securities being used for Paul's obligations, etc., etc. So that actually is the main objective behind introducing this margin pledge repledge mechanism, where the client does not lose any control or any identity of his shares.
Okay, thanks. Mr. Gupta, what do you envisage would be a fraud prevention issue in this mechanism which you have developed?
See, first and foremost, it's about the health of the asset. So, as long as the key aspect about the uniqueness of the asset, the safeguarding the asset coverage. Third is identifying whether the asset health is deteriorating and taking a timely action with respect to replacing the asset, and eventually identifying the breach of the covenants in a timely manner and addressing. As long as these four aspects are covered, that's how I think the investors, end investors, investment into this market actually gets, safeguarded and secure. And what we are looking at in future is, if the banks also start, so a number of these assets are about actually the bank loans which are out there. So this will, so if the banks also are looking forward to taking up the nodes, that's where this whole cycle comes to a completion, or the real benefits of the platform will be, realized, wherein the banks will also be able to monitor the loans actually with respect to the specific issuances on the platform.
Okay, thank you so much. I think we have seen some very interesting uses of technology in our capital markets. Though the benefits may not be immediately, evident, but behind the scenes, they are going a long way in making our markets fair, efficient, as well as inclusive, while ensuring that the client assets are protected and there is efficiency which is getting built into the system. I'm sure we have a lot of questions to ask, which maybe we can take offline, because I already see the next panel is already on board and ready to go, and there's an interesting session which we have there as well. So thank you so much for your time and attention, and we look forward to any such more interactions in future. Thanks a lot.